Alright, so today I wanted to make a video on the covered call ETFs, specifically the more popular ones, and specifically do they outperform, do they underperform the market? I think we're gonna find out that they underperform, but we're gonna get into exactly what and what not. So again, the first one is QYLD. That's going to be the most popular one. It's been around for a little over 10 years now. And as you can see, the share price has consistently lost value over time, right? And that's the concerning thing with a lot of these. And let's get into the dividend here initially. So again, you currently got a yield of about 11.6%, which is very good. But again, you look at the overall returns here. QYLD has returned 58% over that time. The S&P has returned 170, right? So not even close. And again, I'm using Stock Unlock. They're nice in that they have when you go into the dividends tab here, it'll show your total stock returns, including dividends, which is very nice. So again, QYLD has grossly underperformed. Let's check RYLD, which is another very popular one. Again, so it's 1.5 billion in market cap. It's been around for about 4 years now. And it's got a 12.78% yield. If we look at the total returns though, 15% versus the S&P 61% over that time. So that's a big problem there, right? In that it has a better yield, but still not even close to keeping up with the S&P. So let's try another one, XYLD. This is the S&P one. Go into the dividends here. This one is a little larger market cap, 11.5% yield. Although if we compare to the S&P, again, this one's been around since 2013 as well. So again, we got a 78% total return. S&P still more than doubling that, right? So if we look at the big ones here, again, still not performing. Let's check out a different one here. Let's check out QYLG, which is slightly different. This one, rather than selling calls on 100% of the position, this one does it on half the position, right? So again, this one's been around since 2020. Total returns 23%, S&P 38. So again, still underperforming by quite a bit. And I haven't got into it yet, but the reason that these funds underperform is two reasons. Well, one main reason, right? The first one is they sell their calls at the money. And if you don't know what that means, when you're selling options, at the money simply means they're right around, if not right on, the current share price, right? So if the share price of whatever it is $100, you're selling an $100 call, right? The problem with that is it limits your upside for share price growth. The upside is you'll get a higher premium and thus a higher dividend yield, but it limits your share price accumulation, right? So the big problem with these funds is, well, most of them, not all of them, but most of them, is they're selling right at the money. In my opinion, they should be selling out of the money, and in a bull market, deep out of the money, right? They should be selling probably with a beta of like 20, maybe even 10, meaning there's like a 10 to 20% chance that it's going to end up in the money. So, and the reason for that is that if you know what you're doing, for lack of a better way of putting it, you can outperform the market selling covered calls. The problem is you have to know how far out of the money do you sell. And the key is, I mean, it depends on the stock, right? Because, you know, what is going to be out of the, like a stock that's, you know, let's say, you know, if you're selling a 110 call, if that's a very volatile, like a 110 call on a $100 stock, if it's like a, you know, small cap tech stock, that's going to be very, very, that's barely going to be out of the money, right? Or a very, versus if you compare to a super boring company, the return that you're going to get on that for selling it is not going to be nearly the same. You're going to get a lot higher premium on the more volatile company, right? So my point here is, I didn't do a great job of making the point, but my point here is very simple, is that to make these funds better, what they should do is have someone actively managing it that is actively changing slightly how far out of the money they're selling calls. Because if they're just blindly selling at the money, or blindly selling 10% above or 20% above, or whatever you want to say, it's going to limit upside. Because if we're in a very clear bull market, then you want to be selling further out of the money. If we're in a bear market, you could be selling closer to being in the money, right? So I think that's the big problem with these funds, is that they don't do a good job of doing that, right? But let's get into some other ones here, because I know there is other ones. The next one that a lot of people probably would bring up is DIVO, which has been one of the ones that still has performed pretty good, but it still has underperformed, not by that much though. 108% versus, or sorry, the S&P 108% versus DIVO 84. It's been around since 2016, so this one has performed quite a bit better, at least compared to the other ones. But again, we're still not even keeping up with the S&P. So the next one I'm sure people would talk about is JEPI. JEPI is one of the better performing ones. Let's take a look and see. So again, JEPI has been around since 2020. Total returns 41% versus 53% for the S&P. So again, better returns than all the other ones. Maybe not DIVO. They'd be close probably. But again, we're still underperforming the market by a decent amount, right? The only other one that I can think of that I would bring up is actually a Canadian one. This is TXF. This is a covered call on the tech stocks, basically. Again, so 9.4% yield. It's been around since, actually it's been around for a very long time. So again, this one 190% versus the S&P's total return of 229. So again, done a lot better than this one's probably comparable to a lot of the other ones. But I mean, the one thing that I would point out here is if you look up until basically before things collapsed at the end of 21, the start of 22, this one was basically keeping up, right? 233% versus 249. So this one really just got hit hard in the last couple years, right? So if you're looking for actually, like, this one's done better than QYLD, QYLG, borderline better than the other two even. But the problem is that it is a strictly a tech-focused one, which makes it inherently more risky, in my opinion, right? And I don't think anyone would debate that. So again, the main reason that people invest in these funds is for income. And I think people are also getting it wrong in that you don't need to buy these funds to get a high income. You just need to buy good quality companies and hold them for the long run. And right, and what do I mean by that, right? I mean, if we look at the S&P, right, the SPY, again, they're currently growing their dividends about 5.4% per year, right? So if we go back 10 years, again, you have a 2% yield, but let's go back even further and see how high of a yield. No, wait, that's the historical yield. Historical yield on cost. If you go back 10 years, right, you'd have about a 4% yield on cost, right? Let's go back 20 years. You would have about a 7.5% yield on cost, right? So my point here is very simple. The covered call funds, unless they can manage them better, they're really irrelevant, because if you just hold good quality companies that are raising their dividends over time, you don't need these funds, right? You really do not need these funds, right? I mean, let's just go into some basic, like CN. CN is a good one that I usually use because it shows this pretty good. So again, if we go into their dividends here, right? So again, current yield 2%. They're growing at 11% per year. And again, this is a company that has outperformed the S&P over the last 10 years, right? For a boring company, it's outperformed the S&P, right? So we go back 10 years, again, about a 7% yield on cost. But we go back 20 years. Let's go back about 20 years. You would have a 28% yield on cost, right? A 28% yield on cost, right? So my point, again, is very simple. You do not need to buy these very high dividend ETFs, stocks, BDCs, mortgage REITs, you name it, because companies like this will absolutely destroy those companies in the long run, right? I mean, let's go back even further here. If you would have bought CN in 2000, right, the start of 2000, you would have a 49% yield on cost. You're returning almost half the investment per year if nothing happens to the share price, right? Why would you not want that? Now again, I'm not saying that if you buy CN and hold it for 23 years, you're going to get a 49% return. I'm not saying that, but what I am saying is that you're probably going to have more. You're almost certainly going to have a higher yield than QYLD, right? You're almost certainly going to have that. So why would you not do that? And not only that, you have a company that is a very good company, right? A very good company, a company that's going to be around for who knows how long, but that is very little competition. And like I said, I'm not saying that this company is going to overperform, because nobody knows. Do your own due diligence, but I'm just using it as an example, right? So again, that's my overview of the covered call ETFs and why I wouldn't invest in them, right? And the reason being is that they don't do a good enough job managing. All they're really worried about is getting a high yield, but the problem with that is that they do it at the cost of the total return, right? So anyway, that's what I wanted to bring up today. If you liked the video, hit that like and subscribe, and stay tuned for more.